Hello and welcome. We open today on a very intriguing asset class where the demand signals have never been stronger. In my line of business, I'm in financial services infrastructure. I get asked this question every day: artificial intelligence. However, with all this hype, if you strip away the hype, it all boils down to one thing, which is infrastructure. Therefore, if you look at all the signals that are available to us and the data points, they cannot be more definitive. Just electricity production alone and electricity demand is likely to increase by 40% in the next 10 years. Data center build-out is going to require $1 trillion in debt investments in the next 5 to 6 years. So we are really entering a super cycle for infrastructure. So the capital is definitely there, and so the question for this panel really is not where it's coming from, but where in the capital structures are you likely to create more value? What type of capital structures are more appropriate to infrastructure, and how do you ring fence and realize this value? We're lucky that we have a full stack on panel today. We have senior debt, we have mid-market, we have platform equity, and we have sovereign capital. So, can I pass it over to you guys to introduce yourselves, starting with Kashif, please.
Thanks, Vlad. Hi, everyone. My name is Kashif Khan. For those that aren't aware, MetLife, I work for MetLife. That's a 150-plus year institution, serving over 100 million customers on the insurance side. I sit on the MetLife Investment Management that has over 700 billion of assets under management. We're one of the largest private credit investors with over 100 billion of exposure. Within the infrastructure space alone, it's probably around about 40 billion of global investments. And yeah, I'm managing a lot of the European exposures we have in that space.
Good morning, everybody. My name is Catherine Messer. I'm a partner at a GP stake firm called Amen. I lead the London office and I head the investment activity in Northern Europe. And GP stake is a new development in Europe. We take minority stakes in the management company of private equity firms across the asset classes within the alternative segment, such as infrastructure.
Good morning, everyone. My name is Enes Güzel. I'm the UK country advisor for the Investment and Finance Office of Turkey. We are based here in London, in the Turkish Embassy in London. So my role here in the UK is to attract foreign direct investment into Turkey. So we divide investments into two categories. One is the financial investments, where we target venture capital funds and private equity funds to help and support their entry in Turkey. Also the strategic investments, more like production facility, R&D centers, helping and companies to enter the Turkish market. And we also do the promotion side, investment promotion activities as well. And I would like to thank for the organizers for this kind invitation.
Good morning, everybody. My name is Adam Ringer, and I'm a managing partner at Vision Edge One. Vision Edge One is a private equity infrastructure fund manager, which we established 3 years ago when we spun out of a much larger business called AMP Capital, which is one of the largest infrastructure funds in the world, before it was sold. Excuse me. We invest in businesses that are going to be adapting to the infrastructure space, so we're very much focused on growth and equity investments in the space. For my own self, I've been working in the industry for 22 years, for most of the time at AMP Capital, and then following the spin out at Vision Edge One. Good to meet you all.
Thank you so much, everyone. So first question, lay of the land. Where are we in the cycle? Cash, starting with you.
Yeah, it's as you mentioned, there's a number of themes hitting the infrastructure market and kind of booming the sector. So whether it's energy security, with a lot of investments within Europe or globally on how do you make sure you're energy independent, whether it's energy transition, so how do you make it a greener planet. You have digitalization coming through, so data centers, fiber, all the kind of everything that links to data and how do you make that work for the global economy. And so there's a massive need for funding for all of these projects, but then there's also an element of how do you make it affordable for the general public as well. There's going to be high energy costs, high utility costs, and major needs for upgrades across the space. So there's a lot of needs, and the question is kind of prioritization. How do you manage that? And yeah, we're playing across. We're seeing it. We're having. We probably used to invest maybe in the space maybe 500 million a year. Now we're probably hitting 2 billion a year just in Europe of investments in the space.
That's amazing. So thank you, Cash. But to put this in perspective, perhaps, Catherine, so what do you see the most significant developments in infrastructure investment over the past few years? And where are we now? What are the most attractive segments from your perspective?
Yeah, it's quite a broad question. Maybe just a few observations. When I started my career 20 years ago, there was a very narrow definition of what was infrastructure. It was toll roads, ports, and utilities. Now we have seen this definition expanding very significantly to include digital infrastructure, energy transition, social infrastructure. We have seen more private capital flowing into the asset class, and we have seen great deepening of that market, and that comes on different levels, where we see a lot of different strategies, so a much broader set of investable opportunities for investors, a broad range of financing solution, anything from equity to debt, anything in between. We see more types or different types of investors accessing the asset classes, and we also see much more parties and GPs being formed in the infrastructure space, from highly specialized local players all the way to very large diversified platforms. So that is really been a key feature. Maybe one other observation is we have seen also greater trend towards value add, and sometimes the lines are blurring between buyout firms and infrastructure firms. So we have seen for a number of assets buyout firms competing with infrastructure funds, and that you would have not seen 10-15 years ago. And there's much more emphasis on what to do with these assets, long duration physical assets during the holding period than any time before. But obviously, you also take greater operating risk. So I think that are probably as much as I can say in 5 minutes, but happy to cover any other topic later on.
Well, I think let's go around first, and then we'll come back to this, because it's a very exciting topic. I mean, one follow-up question I have, is what does it mean for investors if they were to diversify perhaps their investments? Does it mean that these different flavors of infrastructure assets, one is more attractive than the other, or what would you do?
That is for me as well?
It's for you to follow up,
okay,
and then I would like to then transition to Enes after that.
No worries. So as a GP staker, we look for segments within the infrastructure space where we see structural tailwinds, where we see high barriers to entry, requiring specific skill set and scalable. So, of course, energy transition is one topic, and in our first fund, our first asset was actually a manager in the energy transition. But ultimately, as a GP staker, what is also very important is which manager you decide to partner with. Then from core plus to value add, it depends in terms of your risk appetite, because it's a trade-off at the end of the day. How much operating risk do you want to take?
That makes sense. So let's just transition to Enes then. So in terms of the rising finance costs, how does that change what and how investors look at investing in infrastructure projects?
Because of the high rates right now, now investors are more selective in that sense where in 10 years ago, for example, they could take the risk of construction risk, development risk, but now they are more looking at assets where there is cash flow visibility, downside protection, inflation linkages, and the resilient assets. So in that sense, infrastructure plays an important role because it creates in the infrastructure and the energy areas, it generates essential services like data centers, renewable energy, but also it also provides long-term visibility and more guaranteed asset-based income. So for the long term. So that's why investors today are more selective in that sense, but infrastructure plays an important role in attracting investment.
And then from your perspective as sovereign capital, what are the most attractive elements of those investments in Turkey?
So in Turkey, there are three broad areas. One is the renewable energy, and second is the digital infrastructure, and the third is logistics and transportation. If I can give some information about renewable energy market in Turkey. Turkey is the third largest electricity consumer in Europe. And the renewable energy size, the electric install capacity is around 125 gigawatt. To give you a context, in the UK, installed electricity capacity is around 115 gigawatt. In Italy, 130. In Spain, 130 gigawatt. So you can imagine how much capacity Turkey has got. But in the next 10 years, the government is aiming to increase the installed electricity capacity into 240 gigawatt. So, and that will be allocated to solar and wind. In 120 gigawatt, only solar and wind. So in that sense, Turkey still offers in the renewable energy areas 10 years feed-in tariff, and in US dollar terms. So it prevents the currency fluctuation, and 20 years auctions in solar and wind. And also, what differentiates Turkish energy market from renewable energy market from the Europe is that there is the capacity in the grid. Whereas we face the investors often come and say they want to invest in the renewable energy in Europe, but because of the grid capacity, there is a big challenge. And Turkey at the moment has the 30 gigawatt of energy storage. So to add that. We have recently have a new rule in the permitting licenses. So when you invest in the renewable energy, in Turkey, you are giving the right connected to from the beginning before you start the project. So you are connected to the grid anyway. I can continue with the
well, I think we only, so this panel only has 35 minutes, so we can continue offline, and we're all very interested about the regional perspective as well. However,
sure. I can also a little bit add information about digital infrastructure.
Okay, just a second, because then I will.
Okay, yeah.
Let me transition to Adam, because Adam brings a very interesting perspective. He's in a slightly different space compared with everybody else here on the panel, but he is also very central to the debate that we have going on for the entire conference today, and then we will come back to you as well. So Adam, from your perspective, the core debate is it debt versus equity versus hybrid. Where are we? What is your perspective?
Well, I mean, full disclosure, we're an infrastructure equity fund. But I think there are clearly needs across every part of the capital structure. And coming back to the points on what's changed in the last few years, clearly we've had a situation where rates have increased significantly, and they're still higher compared to a couple of years ago. But when we look at growth opportunities, the things we've discussed already in the panel, energy transition, digital infrastructure, in particular the opportunity of AI, we think the best way to capture growth is clearly equity. And that's why we've created an infrastructure equity fund, actually, because we could have done something else with our lives. But clearly there is also a space and a huge opportunity for private capital in infrastructure. And actually what we're seeing more and more recently, and actually we've been participating in it, is alternative capital structures around things such as pref equity, convertible debt, etc., to de-risk some of those more growth aspects of infrastructure build-outs. I think they've been very prominent in what we've been investing in, and others have.
That's very interesting. So just hold that thought, then over to Cash. What is your view on that? What's your view on the alternative investment strategies too?
Yeah, so we play primarily in the senior debt, kind of the first stack of debt within the capital structure. As Adam mentioned, given the scale of funding requirements in the space, everyone can take a piece of the pie. It's a pretty large pie. The reason, I guess, why MetLife as a major institution has been kind of a long-term investor in this is, again, it's, I think one of the words used was resilience. This is the asset class that people know that we can have long-term returns. You have cash flow visibility. There's the barriers to entry. So that's the attraction of the space. It's a safe asset class. It's gone through GFC. We've gone through COVID, and now we're still kind of having assets that continue to perform. Yes, you've had up and down in various different sectors, but as a whole, it's probably been one of the better asset classes that's kept going. Therefore, there's kind of lower returns generally compared to private equity or other sectors, VC and the likes. But yeah, it's kind of a different pool and kind of different interests. As an insurance company that has long-term liabilities, this is the perfect asset class for us, and it continues to kind of grow. As we mentioned, rates are up. So as a senior debt lender, for the same level of risks, we're adding 3 to 4% than what we would have got back in 2021. I think base rates were close to zero. Base rates were shot up to 5% in 2023. In that period, there was a bit of a slowdown because a lot of the companies started to kind of, maybe we stay short, don't lock in these long-term rates, but these rates haven't come down that far. So we are in this environment of a high rate, which means as a senior debt investor, same level of risk, much higher returns. And yeah, we continue to kind of grow in the space.
Did you say same level of risk but higher returns? That seems to be like a very positive message. Over to Catherine. So there are a lot of interesting undercurrent that are going on right now. So for example, the ongoing consolidation trend and the increasing number of GP stake sales. Can you tell us more about that?
Yeah, and that is also to put in the broader consolidation trend we have seen in the alternative space. Infrastructure has been one of the segments where we have seen a number of consolidation movement in Europe over the last 5 years. And this is because scale matters. We have seen both asset manager and large diversified private equity firms expanding in infrastructure. For instance, BlackRock acquiring GIP, CVC acquiring DIF. And you see that the main reasons behind it is that it is capital intensive to grow an infrastructure firm. We see larger deals requiring more specific set of expertise and potentially some synergies across a larger alternative platform, especially in terms of distribution. So these are really the trends on the majority side. For a GP stake firm, we take minority, so we play into that consolidation in a number of ways. Obviously, that creates potential exits for us, but also selling a minority stake as an infrastructure firm is a way to get the capital to grow and develop the manager while not giving up majority. And also getting the strategic input in getting into the next stage.
So I guess the bottom line is that it's still a positive development, right? Because I'm trying to make sure that everybody remembers the opening panel is something very positive and the underlying messages are positive, right? So we shouldn't be reading into this in any other way.
Yes, absolutely, and it also reflects the attraction of the asset class.
Yeah, you're absolutely right. So then coming back to Enes, so let's continue talking about data centers, power, energy transmission. Obviously, you bring a very interesting perspective of Turkey, so we want to hear that too. The underlying question, obviously of interest for everybody, is that are we trying to underwrite the demand of the future on the basis of our today's knowledge? For example, Turkey is going through a massive infrastructure investment super cycle. But how much data do we have today to support the investment for the next 20 to 30 years?
So Turkey has used very smartly the PPP projects, public partnership, public-private partnerships, and in the last 20 years has attracted over 220 billion worth investment in the infrastructure, whole infrastructure of the country. So relatively, it's a new compared to Europe. So the infrastructure is in Europe is around 40 years old. So therefore, there are the bottlenecks in there. But whereas we talk about AI today, it's technology. Yes, it's a technology story, but it's all down to come to the infrastructure, like energy infrastructure, also the digital infrastructure. Because without for the digital data centers, you need power, right? But for power, you need grid, and you need the grid capacity. Therefore, we have heavily invested in the digital infrastructure in a way that it complements with the energy side. For example, we have right now our first power plant, nuclear power plant, is operational, which will meet the 15% of the whole country's electricity. Because for data centers, you need uninterrupted electricity. So therefore, nowadays we discuss about them because 20 years ago, roads, railways, ports were the backbones of the economy. But today is the data centers, is the cloud infrastructure, is the data storage. And now we are moving very fastly towards the right now digital transition, where banks, multinational corporations, governments, they are all using the digitalized services. Therefore, they need storage for that. And and Turkey is trying to aspire to become a regional hub for the digital infrastructure.
That's amazing point. Let's just hold on that, and then we'll come back to that later. So, same question to Adam from the perspective of underwriting asset classes and demand of the future. How are we doing? Is it even possible to do it in the current environment?
No, it's not impossible at all. It's actually, I think, some of the things you've talked about today give us some guidance as to where they are. So we've talked, and I think a lot of people in this room recognize the very significant growth we require in digital infrastructure. In fact, our team was one of the first ever infrastructure investors doing towers, doing cloud services. So we were actually one of the people who actually created that movement into other areas in infrastructure because we think it's essential, and we've proved to be correct in that. However, that is where a lot of growth is. But I would come up to what you said, Ertas, about the backbone of what we need. That is definitely going to be the backbone, but we still need the old backbone. Mm-hmm. So it's not as if we don't need transport and other in healthcare as well. Mm. And I think that this is the way we see growth, is by focusing on those things that were with the right valuation, which is becoming increasingly harder because of in these hot sectors, but it is possible. But also looking at businesses that are growing and are unaffected by growth, such as by AI, such as healthcare, people still need to be treated. And in fact, AI is a net positive for healthcare because it helps diagnostics. And people still need to move from one place to the other. So we are positioned to capture both the growth of things such as digital infrastructure, as well as invest in the things that are protected from that versus perhaps other sectors that aren't.
Well, that's, just wanted to ask you a follow-up question because I understand exactly what you're saying, especially about healthcare. However, if you compare it to what Enes was saying about building a nuclear power plant, well, clearly the cycles are different. And nuclear power plant is like what Enes was also saying, it's not something that you can switch off. So the electricity that's produced will need to be consumed as well. So, and if it's a very long-term project, you have anecdotal evidence, let's put it this way, because AI and this whole rise of data centers and demand for electricity is a fairly recent concept, right? So how can you project what it's going to be like 20 to 30 years to commit to funding those long-term infrastructure projects?
Simply by, if something as huge as that, by government support. So, for example, funnily enough, we talked about 10 years ago. 10 years ago, we couldn't have imagined a private infrastructure fund investing in a nuclear plant. But we've now seen that in the UK. CDPQ has invested in Hinkley Point C. So that's only possible by long-term government support. And that's probably how people attract private capital to those sorts of projects. But the demand is clear. In a UK context, we have to reduce the cost of energy, and the only way of doing that is by increasing the supply, the supply of energy and that security of that supply.
So moving on to a lightning round, because I'm conscious of the fact that we are running out of time in a minute. So one single highest conviction call that you have in infrastructure investment, starting with Cash?
Yeah,
anything goes. Whatever comes to mind first.
There's a great need for infrastructure funding, but we need to be very careful of the right way of investing. Especially for me, it's on the digitalization, whereby how long, it's back to your point on how long a term view can we take when we may have quantum computing coming in 5 years' time. Yeah. It's a very evolving space, so there's going to be a lot of need, but how you structure that will be quite important.
Catherine?
I will go slightly shorter, Cash. Fail to invest in infrastructure today and you will pay the price tomorrow.
That's a good one. Enes?
Just like Adam said, I agree with Adam. We need to focus on the future with the digital infrastructure, but we shouldn't, from the government perspective, we shouldn't also neglect the other areas like health sector, which we need, all of us, we need. So government needs really put its hands on the infrastructure, and it shouldn't leave the private sector alone, and with supporting with good incentives as well.
And on a positive note, Adam, please.
Of course. So I would definitely support industrial energy that is term contracted within an industrial site in Europe. It is a massive growth area where there's a huge need, and it's very secure because you'll have a 10, 15-year contract for your capex.
Thank you so much, everyone, and thank you to the panel, and looking forward to an amazing event, and thank you so much for attending.